There are several key calculations that are used to measure the financial efficiency of a business. These are formally known as efficiency ratios, and they measure how efficiently a business uses its current assets and its current liabilities, allowing an evaluation of how well management are controlling some of the key financial aspects to take place, such as how quickly money is coming into and out of a business, as well as how quickly stock is being turned over. The key efficiency ratios used by businesses are trade receivable days, trade payable days, and inventory turnover. Let's take a look at what each one of these efficiency ratios mean for a business and how they are calculated. So first up, it's trade receivable days, which shows on average how long the debtors of a business take to pay. In other words, how long do the customers who have purchased goods and services from the business using credit take on average to repay their debt? For example, if the answer to this calculation was 50, this would mean that it takes the customers of a business an average of 50 days to pay for the goods and services which they purchased on credit. For trade receivables, typically the smaller the figure, the better it is for the business, as this means the business is collecting the money it is owed from its debtors faster and in fewer days. The trade receivables day ratio is calculated by dividing trade receivables by credit sales and multiplying the answer by 365. Let's look at an example of a trade receivables day ratio being calculated. So we've got a scenario based on a business called Tom's Tops. Last year, Tom's Tops had trade receivables of £8,000 and credit sales of £90,000. Based on this information, what was the trade receivable days for Tom's Tops last year? If you want to, you can pause your screen now and have an attempt at the scenario on your own, or just wait a couple of seconds and follow me as I work through the example. Firstly, you need to locate the trade receivables figure and the credit sales figure, which in this example, the business has trade receivables of £8,000 and credit sales of £90,000. All you need to do now is apply the trade receivable days formula, which is trade receivables divided by credit sales multiplied by 365. So that's trade receivables of £8,000 divided by credit sales of £90,000 multiplied by 365, which in this scenario, you get an answer of 32.44, meaning that it takes the debtors of the business an average of 32.44 days to pay for the goods and services which they purchased from the business on credit. Let's now move on to trade payable days, which shows how long on average a business takes to pay its creditors for the goods and services which it has purchased on credit. For example, if the answer to this calculation was 60, this means that it takes the business an average of 60 days to pay for the goods and services which it has purchased on credit. For trade payables, typically, the higher the figure, the better it is for the business, as this means the business is holding on to its money for a longer period of time. Put simply, the golden rule in business is to collect money as soon as possible from debtors and to keep hold of money for as long as possible from creditors. In other words, the aim is to have the trade receivables day figure as low as possible and the trade payables day figure as high as possible, meaning that a business can use this money to generate additional interest in a savings account, be invested into other areas of the business, or it's on hand to cover any unexpected costs, rather than the money being sat in the accounts of the debtors and creditors of the business. But, and this is very important, all of this must be done under the agreed payment terms with the business's debtors and creditors. A business should not force a debtor to repay earlier than agreed, or should it hold on to payments for longer than it agreed with its creditors. This would not be a sustainable business practice and can cause serious liquidity problems, as well as tarnishing the reputation of the business and ruining important relationships with debtors and creditors. Anyway, back to the trade payables days ratio, which is calculated by dividing trade payables by credit purchases and multiplying the answer by 365. Let's take a look at an example of the trade payables day ratio being calculated. So, the owner of Tom's Tops is back for more help. Last year, Tom's Tops had trade payables of £32,000 and credit purchases of £160,000. Based on this information, what was the trade payable days for Tom's Tops last year? If you want to, you can pause your screen now and have an attempt at the scenario on your own, or just wait a couple of seconds and follow me as I work through the example. Firstly, you need to locate the trade payables figure and the credit purchases figure, which in this example, the business has trade payables of £32,000 and credit purchases of £160,000. All you need to do now is apply the trade payables days formula, which is trade payables divided by credit purchases multiplied by 365. So that's trade payables of £32,000 divided by credit purchases of £160,000 multiplied by 365, which in this scenario you get an answer of 73, meaning that it takes the business an average of 73 days to pay for the goods and services which they have purchased on credit. Let's now move on to the third and final efficiency ratio, inventory turnover, which shows the number of days that an item of stock is held by a business on average. For example, if the answer to the inventory turnover calculation is 10, this means that a business holds onto a piece of stock for 10 days on average before it's sold. Whether this figure is viewed as being good or being bad is dependent on the nature of the business and the types of products that a business sells. For example, a florist is likely to turn over inventory a lot quicker than a car dealership, but in general, businesses want this inventory turnover rate to be as low as possible because this means it's selling its stock much quicker to its customers. So the lower the amount of days it takes to turn over inventory on average, the better for the business. The inventory turnover ratio is calculated by dividing the average inventory by the cost of sales and multiplying the answer by 365. But these figures may not be given to you in the scenario, so you may need to calculate the average inventory figure and the cost of sales figure first before you can use them to complete the inventory turnover ratio. Let's take a look at an example of the inventory turnover ratio being calculated. Yes, you guessed it, we're helping Tom's Tops again. Last year, Tom's Tops had an opening inventory of £3,000, a closing inventory of £1,000, and the cost of sales was £40,000. Based on this information, what was the inventory turnover for Tom's Tops last year? If you want to, you can pause your screen now and have an attempt at the scenario on your own, or just wait a couple of seconds and follow me as I work through the example. Firstly, you need to locate the average inventory figure and the cost of sales figure. In this scenario, the cost of sales figure of £40,000 is given to you, but you aren't provided with the average inventory figure, and you need to calculate this before you can continue. The average inventory figure can be calculated by adding the opening inventory and the closing inventory together, then dividing the answer by 2. In this scenario, we have an opening inventory of £3,000 and a closing inventory of £1,000. So we need to add these figures together and divide them by 2, which gives you an answer in this scenario of £2,000. This is the average inventory figure that you've been looking for. All you need to do now is apply the inventory turnover formula, which is average inventory divided by the cost of sales multiplied by 365. So that's an average inventory of £2,000 divided by a cost of sales of £40,000 multiplied by 365, which equals 18.25, meaning that the business holds onto an item of stock for an average of 18.25 days.